Let's say someone gives you an adjusted trial balance for a company called the Dancing Squirrel, and they ask you to make a classified balance sheet. Here are the steps I suggest you follow. First, identify all the balance sheet accounts. I think the easiest way to do this is just to go through the adjusted trial balance and cross out all the accounts that don't belong in the balance sheet. So dividends will be crossed out, SG&A expense, interest expense, sales revenue, income tax expense, for example, goes in the income statement, not the balance sheet. Loss on disposal is going to be crossed out, cost of goods sold, depreciation expense. And what you're left with, the accounts that have not been crossed out, for example, common stock, long-term debt, retained earnings, those are all the balance sheet accounts. Okay, so we've identified our balance sheet accounts. The next step is to classify those balance sheet accounts. Is something a current asset, a non-current asset, current liability, and so forth. Okay, so common stock is an equity account. So I'm just going to put an E right here. Long-term debt, that is a long-term liability or a non-current liability. I'm going to put NCL for non-current liability. Retained earnings is an equity account. So I'm just going to put another E here. Equipment is a non-current asset, so I'm going to put NCA for non-current assets. Account payable is a current liability, so I'm going to put CL. Accumulated depreciation is a contra asset account, so it's actually a reduction in an asset, and specifically it's a reduction in this equipment, property, plant, and equipment. So it's going to go in the non-current assets section of our balance sheet. So I'm going to put NCA. Unearned revenue is a current liability, CL. Cash is a current asset, CA. Additional paid-in capital, that's an equity account. So I'm going to put an E. Inventory is a current asset. Account receivable is a current asset. And income tax payable is a current liability. So now we've classified all our balance sheet accounts, and we're actually ready to make our classified balance sheet. There's just one more thing that we're going to need to do. So what we're going to have to do is we're going to have to calculate the ending balance of the retained earnings account. And that might seem a little weird because you might be thinking, hey, we've got the retained earnings balance right here. We see that it is $15,000. So can't we just put $15,000 for retained earnings in the equity section of the balance sheet? No. And the reason is that we have not closed out all the revenue and expense accounts or the dividends account. Remember, there are three types of temporary accounts: revenue accounts, expense accounts, and the dividends account. They're temporary. They're just tracked for a period of time. So we got to zero them out at the end of the period. And we have not done the closing yet. And we could see that because we look and see SG&A expense, $50,000. That account has not been closed out. So we need to close out our dividend, expense, and revenue accounts, close them out to retained earnings. So this is the beginning balance of retained earnings. We're going to have to calculate the ending balance. So I'll show you how to do that. But first, let's take a look at our classified balance sheet. So note that we've got the company name, we've got balance sheet. If you were using IFRS, it would more likely say statement of financial position instead of balance sheet. But it's the same thing, and we've got a specific date. Remember, the balance sheet is as of a specific point in time. This date here, December 31st, 2019. Now, we've got clearly labeled our current assets section, and our current assets are presented in order of liquidity. So cash is always first, then we've got accounts receivable and inventory. And all these numbers here, okay, all these numbers, so the current assets came from our adjusted trial balance. Okay, for example, if you look and see accounts receivable, $40,000, that comes from the adjusted trial balance, and right here we have $40,000 for accounts receivable. Okay, now the non-current assets section, we've got our property, plant, and equipment. You could also have intangible assets, trademarks, copyrights, patents, things like that. In this example, we don't have any of that, so there are no intangible assets. You could sometimes have long-term investments. We don't have any of that in this example. We just have property, plant, and equipment. Now notice, okay, I've made it a certain way where I say equipment net. Okay, that is net of accumulated depreciation. So that is $50,000 for the equipment account minus the $12,000 for accumulated depreciation. So that nets to $38,000. If you wanted, it would also be correct to say equipment $50,000, so to have $50,000 over here, and then less accumulated depreciation of $12,000, and then get to the 38. So you can present them both line items separately and have the equipment and the accumulated depreciation, or you could just net it together. Either way, it's correct. Okay, so we've got our total current assets, $217,000. We got non-current assets of $38,000, adds up to total assets of $255,000. which is identical to our total liabilities and stockholders' equity, which is also $255,000. So let's get to the liability and equity section. So our current liabilities, again, clearly labeled. We've got accounts payable, income tax payable, and unearned revenue. And I got all these numbers from our adjusted trial balance. So we're just plugging in numbers from the adjusted trial balance. The only difference, again, is going to be for that retained earnings account, which we will get to. Okay? Current liabilities are usually presented in order of maturity date. Now, the long-term liabilities or non-current liabilities, so they mean the same thing, right? The terms are used interchangeably. So we've got our non-current liabilities right here. We just have one type. We have long-term debt, which is $30,000. Okay, so our total liabilities, when we take total current liabilities and the total non-current liabilities, we end up with $111,000 of total liabilities. Now, our equity, we've got common stock, additional paid-in capital, and retained earnings. So we add those up, and we get to total stockholders' equity of $144,000. You add that to total liabilities of $111,000. That's where you get the $255,000 of total liabilities and equity, which, again, this matches our total assets. Now, the difficult part, where you're saying, well, hey, where did you come up with this $134,000 for retained earnings? How did you get that number? Because here on the adjusted trial balance, it says $15,000 for retained earnings. Well, here's what we did. You take the beginning balance of retained earnings and you add any net income that the company had, or if it had net loss, you would subtract it, and then you subtract the dividends, and that will give you the ending balance. So here's the formula. Okay, here's the formula right here. So our beginning balance, this number right here, this is from the adjusted trial balance, so this was given. Then we add the net income, which was $179,000. And if you're wondering, hey, how did you get $179,000? Well, I made an income statement. Okay. Now, obviously, so this is not part right here. This is not part of the classified balance sheet. I just needed to be able to calculate net income, which is right here. Okay. I needed to calculate net income so I could adjust the retained earnings balance to get the ending balance of retained earnings. Okay. Because the ending balance of retained earnings equal to beginning balance of retained earnings, the $15,000 from the adjusted trial balance, plus the net income, $179,000, right? We calculated with our income statement, minus the dividends, which were $60,000. Okay, so $15,000 plus $179,000 minus $60,000 is $134,000. So that is our ending balance. And that is why here in the retained earnings in the equity section, so here's our equity section of the classified balance sheet, we have $134,000 instead of the $15,000 that appeared on the adjusted trial balance.